How vulture investors find failing companies before everyone else. Welcome back to the Art of Vulture Investing. In Episode 3, we learned about distressed securities, the tools vulture investors use to make money from failing companies. Now in Episode 4, let's explore how they find those failing companies in the first place. This step is very important because if you choose the wrong company, you could lose all your money. But if you find the right one, at the right time, you could make a fortune. So, let's learn how vulture investors hunt for their prey. Step 1. Watch for warning signs. Vulture investors always keep an eye on companies in trouble. Here are the common signs that a company may be failing. Falling profits. The company is losing money every quarter. Rising debt. It owes more than it earns. Missed payments. It delays or skips interest or loan payments. Legal problems. Lawsuits, government investigations, or fines. Falling stock price. The company's share price keeps dropping. Credit downgrades. Rating agencies like Moody's or S&P lower their credit rating. When a company shows 2 or 3 of these signs, vulture investors start paying attention. Step 2. Use screening tools. Professional investors use tools and websites to screen for distressed companies. Some of them include Bloomberg Terminal, professional tool, S&P Capital IQ, Edgar, SEC filings, Yahoo Finance, or Money Control. For basic data, they search for companies with high debt-to-equity ratios, companies with low credit ratings, CCC or below, bonds trading far below face value, news reports on restructuring, layoffs, or closures. This helps them create a watch list of possible targets. Step 3. Read financial statements. Once they find a possible company, they study its financial reports, especially balance sheet, what the company owns and owes. Income statement, if it's making or losing money. Cash flow statement, whether it has enough cash to survive. They ask, are the company's assets worth more than its debts? Does it still make money in some parts of the business? Can it be restructured or sold for more than it's trading for? If the answer is yes, it could be a good target. Step 4. Study legal and bankruptcy news. Sometimes the company is already in bankruptcy or is about to file. That's when vulture investors go deeper. They read bankruptcy filings, like Chapter 11 documents, creditor reports, restructuring plans, court orders. This gives them insight into how the company will pay back creditors, what assets are being sold, and how much money they might recover. Step 5. Analyze asset value. One big secret to vulture investing is this. The company might be worthless on paper, but its assets still have value. For example, a bankrupt airline may have valuable landing slots. A retail chain may own buildings in prime locations. A factory may have valuable machines or patents. Vulture investors look for hidden value in the company's assets. They compare this to the company's total debt. If assets are greater than debt, there's potential for profit. Step 6. Use insider knowledge and networks. Experienced vulture investors like George Schultze often talk to bankruptcy lawyers, investment bankers, debt traders, company insiders, legally, of course. These people give them tips, updates, and early signs that a company is in trouble. Example from George Schultze. George once invested in a failing car parts company. Everyone thought it was over, but his research showed it still had strong contracts with automakers and valuable equipment. He studied the bankruptcy case closely and predicted that bondholders would recover most of their money. He bought the bonds cheap and after restructuring, made a solid return. That's how deep research and timing work together. What makes a good target? Here's a checklist vulture investors use to decide if a company is worth investing in. The price is very low. There's some hidden value in assets or brand. The company is either already in bankruptcy or close to it. There is a legal path to get repaid. The process will not take too long. Risks are clear and can be handled. If these points match, it might be a good investment. What to avoid? Not all failing companies are good targets. Here are some red flags. HU company has more debt than asset value. It's in a dying industry, like typewriters or DVD rental. There are too many legal cases or fraud scandals. Government is blocking the company's operations. There's no clear way to recover money. Smart investors walk away from these no matter how cheap they look. How many targets do they track? A hedge fund might track 50 to 100 companies at once, but invest in only a few. They wait for the right conditions. This patience is what separates professionals from beginners. What you learned today. Vulture investors look for companies in financial trouble. They use tools, reports, and legal filings to find possible targets. They search for value in debt, assets, and future recovery. They only invest if the risk is worth the reward. This process is slow and careful, but that's what makes it work. The SIZD coming up next. In Episode 5, we'll go into the legal side of vulture investing, what happens in bankruptcy court, how investors get involved, and how they use the system to recover money. If you're enjoying this series, please like, subscribe, and share your thoughts in the comments. Thanks for watching The Art of Vulture Investing.